Hello and welcome to Stockwatch Live, looking forward to the week beginning 29th of October. All eyes will be on Chancellor Philip Hammond's budget on Monday, the first to have been presented on that day of the week since 1962. Investors' primary concern will be whether or not the usual rumours about a raid on pension tax relief finally come to anything more than idle speculation. Higher earners have already paid the price via a lower lifetime pensions allowance and a tapering away of their annual contribution allowance to as little as £10,000. One possibility is that the Chancellor looks to capture more and more people in that net, banking on the fact that no one will shed a tear for those earning more than, say, £100,000 a year. We shall see. Once Mr Hammond has sat down, however, there's no shortage of reports on the companies that are likely to be held in many of our pensions. It's a big week for company results and in particular for the big blue chip companies that many investors are counting on for a comfortable retirement. We've got pharmaceuticals in the form of GlaxoSmithKline, banks with both HSBC and Standard Chartered reporting, and hotels via Millennium and Copthorne. Meanwhile, retailers, including Carpetright, get their moment in the sun, while household products is represented by Reckitt Benckiser. But the companies I want to focus on today are two former privatisation favourites, British Petroleum, aka BP, and British Telecommunications, now just plain BT. I'll also look at High Street bellwether Next and tech investor favourite Scottish Mortgage Investment Trust. Well, BP's dividend came back into focus 3 months ago after the quarterly payout to shareholders was increased by 2.5% to 10.25 cents a share. That was the first rise since the third quarter of 2014. BP was always a fixture of equity income funds before the Gulf of Mexico oil spill knocked a hole in the company's balance sheet. Last quarter, Chief Executive Bob Dudley made a clear commitment to growing distributions to shareholders in future. Thanks to the rising oil price, BP is back on track. Well, that was reflected in a fourfold increase in underlying profits in the second quarter of 2018, and there's no reason to think that BP won't get another strong boost again in the third quarter, with the cost of Brent crude rising as high as $86 a barrel recently. With President Trump determined to squeeze Iran by extending sanctions to the energy sector from next weekend, the direction of travel for the oil price is probably up for the time being. The longer-term question for BP and its rivals in the fossil fuels business is what comes next after oil. BP is placing bets in electric vehicle charging and advanced battery technology, but the race is on to reinvent itself while we remain addicted to the black stuff. In the meantime, the company is a steady income stock, with a forecast payout of just over 30p a share this year and next. The shares yield more than 5%, and in a low interest rate environment, that will continue to look interesting to yield hunters. Well, the high street has been a killing field this year. Brexit uncertainty and our determination to do more and more of our shopping online has seen a string of high-profile casualties. Debenhams this week joined the list of companies planning mass closures and job losses. Not so Next, which has embraced e-commerce to the extent that it now sells more online than it does on the high street. Expect some commentary in Tuesday's third quarter update on Brexit. Next's boss Simon Wolfson is a prominent Leave supporter, and he devoted a full 10 pages of the interim results announcement 3 months ago to detailing the real costs of a no-deal departure from the EU next March. His comments that the biggest risk to the business was ports not coping with the additional volume of customs work they would be required to undertake in that eventuality were a kind of preview of this week's National Audit Office report, which warned of the potential chaos of a no-deal outcome. Next has been a pretty volatile investment in the 10 years since the financial crisis. Between 2008 and 2016, the shares rose tenfold from around £8 to £80 a share, but they've struggled since, in line with the generally grim outlook for British retailers. Another share which has struggled recently is BT. Like the retailers just discussed, BT is fighting on multiple fronts as its telecoms, broadband and entertainment businesses compete in fast-changing markets. Having reported 3 years of declining earnings and with more bad news expected on that front, BT's appointment this week of a new chief executive could not come a moment too soon. Former WorldPay boss Philip Jansen has a tough job ahead of him to turn the company's fortunes around. The business has struggled to please its regulator, which dislikes its quasi-monopoly position, its customers, who are fed up with poor service and high prices, and its staff, who feel badly managed. Most miffed of all are shareholders, among whom I count myself, who've seen their holdings roughly halve in value over the past 3 years. The big question now is whether the dividend is sustainable. BT pays out about 3/4 of its after-tax earnings to its shareholders. Now, that would be okay if the company were a dull utility, but it ought to be a growth company with plenty of competing demands for that cash in the form of investments in the future. The new boss may well feel that he has one opportunity to reduce the dividend to give him a war chest for rebuilding the business. Which brings me to my last share focus this week. This one is actually an investment trust with a thoroughly misleading name, Scottish Mortgage. Despite its rather dull-sounding moniker, this is actually an extremely racy investment vehicle, as a quick glance at its top 10 holdings will confirm. These include Amazon, China's internet giants Tencent, Baidu and Alibaba, Tesla and Netflix. As if all this technology wasn't enough to get the pulse racing, car maker Ferrari is in the mix too. It's quite some portfolio. Now, when tech was ruling the roost, so too was the Scottish Mortgage Trust. Since the financial crisis, Scottish Mortgage's shares had risen from well under 100 pence to 563 pence at their peak a few weeks back. Unsurprisingly, the last few weeks have been extremely painful for manager James Anderson. They've since fallen back to 461 pence a share. So, at the very least, next week Mr. Anderson will need to explain whether he plans to stick to his strongly held tech stock convictions. He's not alone in backing tech, but he's certainly done it in a more uncompromising way than most global investors. Well, that's all for this week. If you'd like to find out more about the companies reporting next week, then visit the Markets and Insights section of fidelity.co.uk. Thanks for watching.